There is a word that has been echoing with haunting frequency through the marble hallways of the Longworth House office building, appearing in the footnotes of secretive Bank for International Settlements, working papers, and now taking center stage in the high-stakes confirmation hearings for the next chair of the Federal Reserve. That word is financial repression. I want to be very direct with you. The economists, central bankers, and institutional whales using this term in closed-door sessions understand its implications with terrifying clarity, even as they take great pains to avoid explaining it in plain English to the voting public. Financial repression is not some fringe conspiracy theory or a doom-and-gloom narrative found on the darker corners of the Internet. It is a meticulously documented, historically validated, and mathematically necessary policy framework deployed by sovereign states when their debt obligations transcend the limits of structural sustainability. To understand where we are headed in 2026, we must first look at the blueprint established between 1946 and 1974, a period where the United States successfully liquidated a mountain of World War II debt, not through growth or austerity, but through a silent, systematic heist of purchasing power. The conditions that necessitated that era, a debt-to-GDP ratio screaming past 100%, a fiscal deficit that cannot be closed by tax hikes without crashing the economy, and a political class that lacks the courage to cut spending are not just present today, they have metastasized. However, the dangerous delusion currently circulating on social media is that we can simply copy and paste the 1946 solution onto the 2026 reality. The mechanism of repression remains identical. The government must ensure that the interest rate it pays on its debt stays significantly lower than the rate of inflation, creating what we call negative real yields. If the U.S. Treasury owes $36 trillion at a 3% nominal interest rate, while the real-world cost of living is rising at 6%, the government is effectively being paid 3% per year to stay in debt. The debt doesn't get canceled by a magic wand, it gets inflated away at the direct expense of anyone holding cash, government bonds, or fixed-income pensions. This process is the ultimate stealth tax, requiring no congressional vote, no public debate, and no signature from the president. It is a slow-motion default that preserves the nominal integrity of the dollar while gutting its internal value. To understand the gravity of our current trajectory, we have to look at the sheer weight of the numbers. The national debt is currently compounding at a staggering $7 billion every single day. And for the first time in history, the annual interest expense on that debt has crossed the $1 trillion threshold. This means the United States is now spending more on interest than it spends on its entire global military footprint or the entirety of the Medicare system. The traditional exit ramps for this crisis are now physically blocked. To close a $2 trillion annual deficit through taxation alone would require a tax increase of such magnitude that it would trigger a Great Depression-style collapse in consumer spending. Conversely, to cut spending enough to balance the books would require gutting Social Security and defense, the two-third rails of American politics that no administration, regardless of party, will ever truly touch. This leaves the Federal Reserve and the Treasury in a corner where the only remaining move is the liquidation of debt through inflation. But here is the critical distinction that most macro analysts are missing. In 1946, the United States was the world's undisputed creditor nation, owning 80% of the world's gold and possessing an industrial base that was the only one left standing after the war. The world had to hold dollars because there was no other functional currency on the planet. Today, the U.S. is the world's largest net debtor with a negative international investment position of $26 trillion. And for the first time since the Bretton Woods Agreement, the global reserve status of the dollar is being actively and aggressively challenged by the BRICS Plus nations and a surge in de-dollarization protocols. When we talk about a regime change at the Federal Reserve, often linked to the appointment of figures like Kevin Warsh, we aren't just talking about a change in the person sitting in the chair. We are talking about the end of central bank independence. We are moving into an era of fiscal dominance, where the Fed's primary mandate is no longer price stability or full employment, but rather the yield curve control necessary to keep the Treasury solvent. This is why the smartest money in the world, the central banks of China, India, Poland, and Turkey have been vacuuming up gold at the fastest pace in modern history. They aren't buying gold because they are gold bugs. They are buying it because they know that the paper gold of U.S. Treasuries is about to be subjected to a 30-year cycle of negative real returns. In a regime of financial repression, the losers are clearly defined. They are the sellers of scarcity and holders of paper. If your wealth is stored in a savings account, money market fund, or 10-year treasury bond, you are the person paying for the government's past profligacy. The winners, conversely, are those who own real assets with intrinsic scarcity and pricing power. This includes high-quality equities of companies that can raise prices faster than their input costs, physical real estate financed with fixed-rate debt, where the debt erodes while the asset appreciates, and hard commodities like gold and Bitcoin that cannot be printed into oblivion. The market is currently whispering a truth that the headlines refuse to scream. The era of easy alpha through bonds is dead, and the era of wealth survival through real assets has begun. The 1951 Treasury-Fed Accord once separated these two powers to protect the American saver, but the sheer gravity of $36 trillion in debt is pulling them back together into a forced marriage. If you are waiting for a return to normal, or a Volcker moment, where rates go to 15% to stop inflation, you are waiting for a ghost that cannot return. The current debt levels would make a 15% interest rate lead to an immediate sovereign default. Furthermore, we must analyze the Warsh plan not as a partisan maneuver, but as a structural necessity. His critique of the Fed's balance sheet and the need for a rules-based regime is actually a signal that the discretionary era of printing to save the markets is evolving into printing to save the markets. This shift creates a massive volatility trap for the average 60/40 retirement portfolio, which relies on bonds to hedge stock losses. In a financial repression environment, stocks and bonds often sell off together as inflation eats the real return of both. To survive this, one must understand the difference between nominal wealth, the number on your bank statement, and real wealth, what that number can actually buy at the grocery store or the gas station. We are entering a period of economic gaslighting, where the government will tell you the economy is growing because GDP numbers are up, while ignoring that those numbers are only rising because the currency they are measured in is falling. This is how the debt-to-GDP ratio was lowered in the 1950s. The GDP, the denominator, was pushed up by inflation, while the debt, the numerator, was held down by suppressed interest rates. The final point to grasp is that this is a global phenomenon. From the Eurozone's crumbling bond architecture to Japan's decades-long experiment with yield curve control, the entire developed world is caught in the same debt trap. The escape hatch isn't moving your money to another failing fiat currency. The escape hatch is exiting the fiat system altogether through assets that the state cannot manufacture at will. As the global debt supercycle reaches its zenith, the choice for the individual investor is clear. Recognize the signal amidst the noise of currency devaluation, or remain the silent funder of a state's insolvency. This isn't just about headlines. It's about the cold, hard math of survival in an era of engineered inflation, where the primary goal of policy is to keep the system standing at the cost of your future purchasing power. Therefore, as you watch the upcoming Fed appointments and the rhetoric regarding debt cancellation or restructuring, remember that in the world of high finance, nothing is ever truly canceled. It is only redirected. The new Fed chair isn't coming to save the saver. They are coming to manage the liquidation of the largest debt bubble in human history, and if you aren't positioned for that reality, you are the one being liquidated. Pay attention to the flows, not the speeches. Watch the gold. Watch the real yields. And realize that the only person responsible for protecting your purchasing power in this age of repression is you.